changes, but quite frankly, we've got something bigger in store, so we should very quickly introduce ourselves. My name is Victor Jones.
I'm Chris Vecchio. How are you, Vic?
I'm doing great. I'll tell you why. Normally, you can't get me out of a hoodie, Chris. Every day, hoodie or t-shirt, hoodie or t-shirt. I classed up the joint because of our very special guest that we have on today. But before we get to him, say what's up to the people. We give them the lay of the land here, Chris.
Let's do it. And before we get there, of course, if you're watching on the Tastyworks desktop app, tastytrade.com, come join us on YouTube Live for a great chat today with the special guest, second one this week. Of course, when you're here, like and subscribe for more great content from Vic Jones and the Tasty Trade team.
Yeah, man. Shout out to all the savages in the chat. Let's trick the YouTube algo. Just start typing in random ass characters and let's get this place popping. Hit the like button as well. Without further ado, you and I were super excited once we saw this on the calendar. This was easily a fan favorite. I think we did 5 times the normal volume to our show the last time we had this gentleman on. Ladies and gentlemen, traders around the world, without further ado, we'd like to introduce again to the Jones and Fred Show, Jem Carson. Jem, welcome.
Hey guys.
How you doing,
Good to
man?
be back. Yeah, doing well.
It's great to have you. We classed up the joint. Normally we're in hoodies and t-shirts, but we had to class it up.
Looking today. Sharp. I gotta bring my game today.
Jem, we were kind of thinking about the direction we wanted to take this. Last time, I think you illuminated a lot of people with how to think about not only politics, monetary policy, the forces of fairness or unfairness, and how that could potentially change the political headwinds. We read your investor newsletter, and I was really fascinated not only with how much it dove into history and how much it basically paralleled the echoes in history, the rhymes in history from a previous period of time and now, but also how you broke a lot of assumptions that people are holding on to right now. And I wonder if you would do us a favor. For you, it might be a little bit old hat, but I was wondering if we could take a walk through history and really explore that 68 through 82 period. And you just give us the Jem Carson experience, help us to understand why that period is important, what people are misunderstanding about that period, and also what we can take from that period and sort of utilize in our mental models as we think about risk in the current world going forward. How are you thinking about that?
Yeah, I'd love to. Let's do it. Let's take a walk down memory lane.
Let me set this up real quick. I want to just show the audience, share the screen. And there's sort of this model out there, generally speaking, Jem, that as we got into the early 70s, that the central bank, and you made this statement in your investor newsletter, effectively the central bank didn't do their job. And by the time Paul Volcker came around, he knew what to do. He was the savior. He jacked up rates to 20+%. And he in effect, saved the U.S. economy, even though it plunged into a deep recession.
It's a wonderful story, isn't it?
It's like the
hero's journey.
Paul Volcker is the knight in shining armor that we should all ascribe to be. And there's sort of this question, right? Like this question, who is
I like that graphic.
Do you like that? Who is our current Jerome Powell? Is he Arthur Burns or is he Paul Volcker? And I wonder, before we get to the answer to that question or whether that's even the correct framing, take us back to this period of time. Explain to us what you think was happening there and what people misrepresent from this time. And then we'll go to this question of whether or not Jay Powell is Arthur Burns or Paul Volcker.
Yeah, I'll start from 30,000 feet. Look, the Fed wants you, and everybody in power wants you to believe, and this is not a conspiracy, they want you to believe that they have control, that they know what to do and they can save the economy. They can, and there's a reason for that, because if they have people in the markets trusting them, they can manipulate the back end of the curve. They can use their rhetoric and all their things, to manage the situation. So it's important. So you hear a lot about Volcker and Volcker's successes. You don't hear much about Arthur Burns or William McChesney Martin. And if you do, it's a lampooning. It's a talking. They generally are spoken about as if they were negligent, incapable of doing the right thing at the right time, et cetera. The furthest could be from the truth. They can say that about Arthur Burns a little bit, because he didn't take real rates positive, right? That's the argument, at least. But you really don't hear about William McChesney Martin, which I think is interesting because he took rates incredibly positive.
Mm-hmm.
William McChesney Martin in 1969, in response to the inflation that was going higher, took interest rates up, Fed funds rate up 7.5%. Took the real yield positive 2.5% and caused a mild recession. He held it there. It was a long recession, despite being mild. Held it there for a year and a half before turning back around or pausing. And as soon as he paused and started lowering rates a little bit, inflation took off. Inflation jumped to new highs, jumped another 6-7%. And why was this inflation there? Let's start let's go back to the beginning.
Mm-hmm.
John F. Kennedy, which I actually don't talk about this in the paper, but it's important to understand. Before John F. Kennedy got assassinated, he had a big push to try and cure poverty and really, to do, some big programs. It wasn't called the Great Society at the time, but it was essentially the roots of the Great Society program. And the public was broadly interested, but there wasn't enough movement. When he died, LBJ took
Mm-hmm.
the political will that was there behind it, uniting both sides, and brought forward the Great Society program. It was the biggest spending package since the New Deal in the 1930s, and it was meant to cure some of the ills, some of the poverty issues that existed at the time. I talk about it in pretty good detail, but some of the things that came out of it was the Medicare Act, Urban Housing and Development Program, Elementary and Secondary Education Act, so making that available to all. A lot of things, right, that we expect nowadays and are part of the everyday. A broad sweeping program. Massive fiscal spending.
Mm-hmm.
That's the important part. On top of that, we were in a time of increasing interest rates and much more as we are now. And I think we should talk about this maybe a little bit later, but these things cluster. When interest rates are going higher and inflation is higher, resources are scarce. Everybody is, nationalism reigns, protectionism tends to reign. And everybody's kind of scrambling over resources. And when that happens, there tends to be more geopolitical strife. So we had geopolitical strife too on the back of this, the Vietnam War. That also increased spending dramatically and had a lot of fiscal policy that went into that. On top of that, you have scrambling of other resources. We, on the back of this, had a OPEC crisis, which many people talk about. Everybody talks about these like they're independent events and completely not correlated. They just magically appeared. But it's weird because we're getting the same stuff now, right? Is that just a weird coincidence? The reality is we're in a competition game. We're moving away from a cooperation game, which tends to happen when monetary policy is dominant and multinational corporations are pushing profits and everybody's winning. But now we are competing over resources internally, externally, globally. Anyway, so kind of bounce around a little bit here, but let's get back to the history. So on the back of that Great Society program, structural inflation, right, really was pushing, inflation higher. So you have cyclical inflation and you have structural inflation. Mm-hmm. The Fed was able to stop cyclical inflation by raising rates, Fed funds 7.5% in the short term, but that structural inflation was still there. That core inflation. You had a massive, increase in labor rights during that time, unionization, much like we're starting to see now as well. Just the beginning, but we're starting to see, the popularity of these things. You had, again, much more protectionism, as I mentioned, as well. A lot of policies that ultimately drove, other than just the fiscal spending, a very hot economy, demand push economy, right? Where the money was actually going to demand to the people, and they were demanding higher wages, right?
Mhm.
They were demanding because they were doing well enough where they didn't have to work for the same prices, right? So not only was the more demand in the economy, it's pulling away supply, which is how the system works. When demand increases, you have a demand push economy. There's also less supply of labor because people don't need to work as hard because they have money and they're happy and they don't need to kind of grind. And that's what, we're at the beginning of those stages, right?
Mhm.
The important thing to note is this is the very beginning. This is the 1960s. We're not in the 1970s. If you look at now in comparison, right? The millennial generation is at 40% of where the baby boomers were in the 1960s, right? In terms of wealth creation, in terms of household formation, right? They are way behind on a lot of different metrics for where the baby boomers were in the 60s. So take what was going on in the 60s and now take a group, the newest kind of generational bulge, right?
Mhm.
Walking while another generation, which didn't exist at the time, is dying off and retiring, and labor is naturally kind of falling off. So there's demographic issues, a need to catch up in terms of fiscal policy more than there was in the 60s. So this is not just a repeat, it's actually in many ways
exaggerated.
the same exaggerated situation from that period. Anyway, so William McChesney Martin tried to fight it, raised real rates positive 7.5%, didn't work, right? Arthur Burns came in the 1970s while inflation's even hotter, right? Under Nixon, right? He actually raised the Fed funds rate 10.5%, right? Think about these numbers, right? 7.5%, 10.5%. We're sitting here talking about 4.5% long-term rates, and people are going crazy. Like, you're insane. Like this, the market can't handle it. It won't happen, right? They went 7.5% and 10.5%. I mean, we're talking about him, Powell being Volcker. I mean, but we're talking about how how it's crazy that he's raising rates to the extent he is. I mean, we're not even halfway there, if you ask me. Especially at inflation being where it is at this point. So anyway, Arthur Burns with Nixon. So by the way, Nixon was a Republican. He was a laissez-faire Republican, actually a very pro supply. But it didn't matter. So everybody's talking about how fiscal policy we're not going to have more of it. Like the Republicans are going to get into power here. And we all know, what's causing the inflation, this fiscal policy. So they wouldn't pass more. Meanwhile, we continue to see, it's not called fiscal policy, the Inflation Protection Act and the, first-time home buyer tax credits and giving education loan, forgiveness, like all this stuff sends money to people, right? And at the end of the day, is fiscal policy, is demand-side economics. And much like Nixon, who was a laissez-faire Republican, regardless of what party you're in, if you want to get reelected, that is what is popular. And it is increasingly popular because the millennial generation is growing into political power. And they have gotten the short end of the stick for about 40 years, right? So all of this, right, is it all rhymes. It's a bit different and a bit more exaggerated because, back in 1960, we weren't coming off a period of 40 years of monetary policy driven economics. Inequality, as measured by the Gini coefficient, you can go look at a couple of other metrics, was not nearly as close, nearly as high as what it is now, right? We're in a period right now where inequality has been growing for 40 years as a function, as we talked about last time, of monetary policy, right? Monetary policy has been dominant for 40 years. All the money has gone to supply. And here we are after 40 years and historically low rates and really high malinvestment in a situation where that has to be unwound in order to address that. So again, bouncing a little bit all over the place, but the history rhymes in a lot of different ways. When the important point here is when you address inequality, when you try and address populism and take money to maximize, I think this is the important idea, median outcomes as opposed to mean outcomes, right? You're not maximizing GDP, but you're maximizing what the median person gets. That is actually suboptimal for GDP growth, although it may be optimal for the average person, right? And that creates more inflation, right? And less optimal growth. But that is something that you need after 40 years. You need it for societal cohesion, right? You need it, again, for fairness. And we've talked about the idea of fairness and whether, you can talk about whether we should be doing that or shouldn't be doing that. That doesn't really matter. That's what the people are demanding, and that's where we're going. So again, bounce around a little bit, but if you look at Volcker finally having success in the late 1970s, it wasn't a function of him doing something that wasn't done before. I mean, yes, he went back and did it twice, right? But the reality is, the reason it worked was not because he was some heroic person that did something that nobody else tried to do. I want to reiterate, Arthur Burns did it 10.5% right before him and caused the biggest recession since the Great Depression. There was a massive recession, right? Multi-year in 1975, 74, 75, that he could not continue to raise rates into, right? People were, the inflation was it was stagflationary. It was so bad that, that Nixon didn't have a chance at re-election, and Arthur Burns, people were sitting at the door of the Federal Reserve, clamoring at the gate. So ultimately, he did stop and slow down, right? Because they needed to address some of and there was more importantly, more populist spending, more fiscal spending on the back of that, right? When you're in the middle of a recession that's the biggest since the Great Depression, shocking, the political powers that be are going to try and help the populace, especially when there's a populist push. So it actually made it worse. It created more inflation on the back of that again. And then Volcker came in and did the same thing. The difference was after 14, 15 years in 1979, inequality, the Gini coefficient had reduced. The generation who had gone through the 60s and early 70s had grown to an age where they had accumulated wealth and were interested in different things, not as much populism, right? But more economic growth, not more economic growth, more capital appreciation. The interest rates were high, right? And there was potential energy now to bring them back down, right? Given where valuations were and the rebalancing that had happened, that had come down. All of these things it was a right decision at the right time. The populace, the people were ready for that period to end. It was important to break that psychological inflation, that idea of, that long-term inflation, interest inflation would stay in there. That is an important concept. I'm not saying that that's not relevant. Obviously, once long-term inflation expectations becomes entrenched, people start bringing demand forward, right? People have the ability to then take lower interest rates if interest rates are negative and buy anything pinned down, right? And profit from it, which push inflation higher. So it's important to stop that. I'm not saying that's not important, but it won't work to cure structural inflation, right? I think that's the important part. And structural inflation had weaned out by the late 1970s, early 1980s, and Volcker was able to stem the tide. Right?
And this is I'm gonna pass it over to Chris here because I know he wants to do a follow up. But really quickly, this was when I read your investor newsletter. This was the thing that stuck out to me as a contrarian view, which was most people they'll look at previous data. A lot of people didn't live through this time period, right? So you're going to look at your charts, and then you're going to make an assumption. The assumption that many have made is that had the Federal Reserve early on just done what Volcker had, the intestinal fortitude to do what Volcker had done, then perhaps you wouldn't have lived through this 10 to 14 year period of really difficult secular inflation, and that you would have basically put that genie back in the box much earlier. And in reading your paper, you're explaining that there are forces that can create longer periods of secular inflation, and that while the Fed is taking perhaps what they are explaining to the marketplace, we're taking a different path. We're going to do the Volcker path, which is raise interest rates and stay there for longer instead of easing those conditions. and the market saying, oh, okay, you're going to do it the right way, and you're immediately giving them the credit. That's, you see these inflation expectations, long-term break evens, they all look exactly the same. Everything comes back down to 2% over the next couple of years. And if you, in coming away from your paper, I realized that these are all massive assumptions that assume all of this inflation that we're seeing is cyclical in nature, and not secular. To sum up the core of this point that I thought was absolutely brilliant, I thought it was contrarian, and not a lot of people are saying it. I'll leave for Chris. I know he has a follow-up question, and then I got a few for you as well.
Yeah, Jim, I'm thinking about the demographic situation that we're facing right now, and it is completely different, right? In the 60s and 70s, you now have women entering the workforce, you have minorities entering the workforce, you have a lot of immigration still in the system, but those tailwinds don't necessarily exist right now. Those have been fundamentally changed, and in the past 4 or 5 years, immigration has actually fallen off quite substantially here in the United States, perhaps even contributing to what may be perceived as a labor shortage for lower end jobs right now in the country. So I heard people like Kathy Woods complaining about deflationary forces coming down the pipeline, just simply looking at like the NFIB small business prices expected index. If you put that forward 6 months, it potentially points to, core PCE being right below 4% sometime in early 2023. Is there a deflationary impulse that's going to be making its way through the economy soon? Is this structural inflation conversation that the Fed is worried about overblown? And does that mean they don't have to do as much as they fear they're going to have to do, at least what the market fears they're going to have to do over the next year?
Look, we are going to get some cyclical deflation, right? The point here is that will only nick the armor of what is otherwise a major structural imbalance. We have to demographically, politically, the people are demanding it, that are they're coming to political power. We will have to give more money, and I've been calling for this for a year. We continue to see it. More money to that demographic that is in their prime spending years. There will not be a choice. It is a political. These politicians will not get reelected unless that is done. It's that simple. That's the demand side. Now let's talk about the supply side, right? Labor is, as we mentioned, right? At a major deficit given baby boomers' retirement. There is, from 40 years, I think this is an important point. Over 40 years of monetary policy, we've driven globalization, right? Massive globalization. China, it's not a coincidence that Nixon opened the doors to China, and here we are 40 years later with, now in competition with them as almost as equals, right? That is now going the other way, right? And we created a technological revolution, right? In the process, by sending money to corporations, we've created the Amazons, the Ubers, you name it, the Googles of the world, the Teslas of the world, a lot of companies that didn't make money for 20, 30 years and were able to bet on moonshots because money was free, right? And so those are the two of the three legs of the deflationary stool that has been kind of keeping us, the Fed in control for 40 years. What happens when you start one by one kicking out all those legs of the stool? At this point, we are going to a protectionist. Again, this all really started a decade ago. I want to be clear. This is not like it happened overnight. Nobody really talked about it till recently, but we had, Occupy Wall Street. We had the Tea Party, right? Both sides were incredibly populist starting about 2010. Nobody listened, except a couple people on the fringes named Donald Trump and Bernie Sanders, right? And the more they started talking, right, to these people, they became more politically dominant, right? And people think they're two ends of the spectrum. They're the same populist, forces in politics. And Trump, in particular, bringing the right left is really the important point that was, the market was waiting, the populace was waiting for it. When he brought the Republican Party left, all it took was a spark. It was a kind of, the gas was flowing and it was just waiting for a spark. And COVID was that spark, much like JFK's death was the spark in the 1960s, right? So, and that released the gates of okay, we have to address this. We have to give the public what they want. But again, once this gets started, it doesn't stop, right? And it drives a lot of other issues. We're going to be onshoring more and more work here. That's expensive, right? Commodities are going to become, harder to get because again, you're taking your one by one, disconnecting all the pipes that connected everything during a period of globalization. And again, technology is actually going to slow. It's not going to happen overnight, but the less money you send to corporations, they will have to worry about today and profits today in order to keep the lights on. And they won't be able to do moonshots and invest in as many new technologies and new things, especially not at the scale they've been able to. So very much believe that all of these trends are now going in reverse after 40 years of going in one direction. That's singularly tied to trying to rebalance inequality and the populist movement.
Well, this is the interesting part, I think, about your thesis, because there are many who will speak to deglobalization, right? No longer access to cheap labor, cheap energy is going to become harder to come by. Global trade is less lubricated as it was over the last 40 or 50 years. I think many people are perhaps coming to grips with that, if not the reality of, their impacts in terms of price over a longer period of time. But that reality is slowly sinking in. What I read in your paper, though, that this populist force is going to so the inequities that have been created by sending more or cheap labor to capital, and the inequities that have effectively been created due to that, it creates this demand for righting the unfairness that was created over 40, 50 years. So then I think, well, then how does Jem think about the midterms, right? Because the marketplace will look at the midterms and they'll look at predicted, they'll look at pricing, and they'll say, oh, there's a decent chance that there's going to be gridlock in Washington. Therefore, I can expect that fiscal impulse to perhaps shut down, and I just got to worry about Jerome Powell and whether or not he's got the will to beat this thing, to whip inflation now, to use that 70s phrase. So how does Jem Carson think about the midterms in terms of this populist demand that perhaps you think it doesn't even really matter who's there, that the people, red or blue, are going to demand?
That's the big takeaway, right? Mm-hmm. The left and right, they're the same at this point. They're what matters is what the people are driving for. And in the short term, you can get deviations, right? People can try and go down the other path. It just won't be popular. Mm-hmm. And eventually they won't. And again, this isn't a straight line. This whole process these are big, multi-decade trends, right? I would actually argue, and we've seen this, I was arguing this before, wasn't very popular before, but you're starting to see it, that the policies that Biden is passing are actually are quite popular, whether he is or not, right? And it was almost a foregone conclusion about 6 months ago that he was incredibly weak, and the Republicans were going to win the Senate and the House in a landslide, right? Mm-hmm. And a lot of people are attributing that move, the resurgence of the Democratic Party during this time to Roe v. Wade and a lot of other issues, right? There are social issues involved for sure, but I do think it's important to note he's had a lot of successes that are populist, right? Which is a big reason why he came to power in the first place, or had enough of that. Was able to bring both sides together to some extent. Again, I'm not Democratic, Republican. I want to make sure this is not a political statement. I don't at me on Twitter like this is not a political statement. The important part is the forgiveness of college debt. All of the fiscal policy that's been passed, which has been largely helpful to the populace, and what they've been clamoring for has been popular on both sides. And so I think the Democratic Party during the midterms is going to do better than expected. I think that would be my big takeaway, which is, they're uphill. Midterms are always a bad time for the party in power. But all things considered, given the inflation, given all the other issues that are going on, I think that, again, we're already starting to see it, but I think people are going to be surprised.
So, Dan, if I could just pivot off of that quickly, because I'm thinking about the election playbook thereafter. When I think about Biden's successes, gas prices have come down. You've seen the PACT Act, you've seen the CHIPS Act, you've seen the Inflation Reduction Act, student debt relief. I mean, his approval rating is up to about 49% now, which is, nothing short of a very strong recovery in a short period of time. But it still appears from the polls that we're going to get gridlock in DC. We're going to have a Democrat-controlled Senate. You're going to have a Republican-controlled House. When you think back,
I'm going to disagree with that.
Well, let's
I think we'll have both parties. I do think that the Republican Party is going to win the House. That's not what I'm disagreeing with. I started to interrupt, but I do think it's important to note that it's easy for Republicans to oppose things when, it was almost a not best case scenario when there's one, the ability for that one person to control and move things, and Republicans to not go along with policy. When they control a party, control part of the government, they're going to have somewhat of a pressure, right, to do things for people if things are not going well. And I think there's a likely scenario where this market continues to have, we go into some type of recession, it might be mild, but something where people are demanding more help in the next year. And, there's a bit of a need to act, maybe in a slightly different way to differentiate themselves, but they're going to have to act. And I do think, Biden actually wants to reach across the aisle. I think he's going to move to the middle even more than he has. And I think Republicans, I think people, again, will be surprised, but I think you'll see Republicans having to work with Democrats to pass legislation. And it might be actually common sense legislation, right? I actually am fairly optimistic that we get a period, a surprising period of relatively good policy where both parties are involved. I know that sounds almost unthinkable, but I think that people are being driven together by this populist kind of ideals. Sorry.
So you don't see like a 2010s repeat where when you had the split House or split Congress under Obama, where there's just gridlock, nothing gets done, debt rating gets cut. That's not the same type of 2020 as you say playing out right now. History is not repeating necessarily.
I don't think so. And we will see a lot of that is dependent on factors that we can't necessarily know. How bad is the market route? How bad is the economy doing? Right. Et cetera. But I do broadly think that the left and right are, in terms of the people, in terms of the actual populace, are actually coming more together in terms of what they want. Yes, on social policies, politicians are trying to divide and conquer and doing all these things. But I do think, and we're seeing the popularity of some of these populist policies, which are, again, spanning both sides. So yes, there's the politics of personality, which plays a role, right? But in actual policy, I think the more and more they keep passing policy that's popular, at some point people are going to look back and say, wait a second, he starts listing the things he's done, and people are like, I like that too. We're actually doing some things I agree with. So I do think we're heading there. We'll see. Maybe I'm being naive, but again, I've been watching this stuff for quite some time.
Jim, I wonder if I could get you to let's go volatility for a second, right?
Let's do it.
You've talked about, I love the way you talk about options. You talk about them as a superior technology, and I think that's such a brilliant, simplified way to think about them. And I know, generally speaking, you see the world through distribution curves, right? You don't see the world as a set of binary outcomes necessarily. There's risk here and there's potential here. I wonder, this market has been a little bit unique in my personal opinion. You've got a de-risked market, a de-risked multiple, but it seems like you start getting to these levels, this 3,800 level or whatever the case may be. And while it is de-risk in one sense, you've got light liquidity, and it seems like the velocity of risk potential certainly favors the downside. You have a really unique, a more academic way of explaining what that distribution is. I wonder if you could explain how you see risks and the distribution curves for everyone out there who thinks about it in a similar way.
Yeah, no, I appreciate that. So look, you've heard me talk about this. A lot of your listeners probably have, but the reality is that options, this concept of Gary and dealer positioning, the reality is options are not just an insurance contract. It's not like a tornado, not like tornado insurance where it has no effect on the outcome, right? Whether or not a tornado comes through town or not is not affected by the tornado insurance that people may or may not hold. In the options market, that positioning, right, ultimately has a massive reflexive feedback loop to the outcomes at hand. And so we've been talking about this for some time. We've seen it, in real time here in the last year in a major way. People were very, very hedged for this incoming macro flows issue. The Fed has telegraphed that they were going to be raising rates to some extent, right? Many people foresaw some of the issues and were hedged. Skew was at record highs before the decline. So what happens when you get a decline? Well, all these people own that put protection, and as the market goes down, what do? They try and monetize it because they need to monetize their hedges, and everybody's trying to do the same thing at the same time. So what does that do? That pins, that provides supply of implied volatility in the markets. Dealers get buried in volatility on the way down, and that stems and slows down the move to the downside. Now you can't reverse. I won't say can't, but it's hard to reverse major macro effects like the Fed massively raising interest rates to battle inflation, all these macro features we're talking about. But it can slow it down, and it can definitely affect the volatility and speed under which it happens and the dynamics that play out and the path that plays that we go down. And that's what we've seen, right? You've seen it in real time. You've had on one side this tug of war of the macro and all the major flows, the QT and everything that's happening to push the market lower. Mm-hmm. On the other side, you have this reflexive, constant supply of vol. Anytime the market goes down, vol gets absolutely decimated because the world is long hedges and long insurance and has to monetize at the same time. So now, there are cycles. This goes on and on. People catch on, right? People start abandoning their hedges because they're not working as well. And people start going out the risk curve and taking more risk and selling puts and selling stock against it. And because that's an incredibly profitable trade in this environment. A lot of other people, start, funds that do these types of things start getting more money. Long vol funds that were meant to hedge that aren't working get redemptions, right? So this all plays out over time. It's a function.
Meanwhile, people are on television going, maybe inflation's not so bad. And then the next day they're like, oh my God, inflation's horrible.
Right. Everybody's trying to point to some macro, like everything is some news related. Positioning is irrelevant. People don't understand, right, the internal dynamics of markets, but they're critical to understanding, again, at the end of the day, supply and demand is what determines price. You can talk about qualitative factors that affect it. But at the end of the day, positioning is a massive input to supply and demand, right? So
if I could break that down real quick. So basically, the Fed, they told everybody what they were going to do. Some people believed them, some people didn't. If you believed them, you bought some cheap hedges. You basically got an umbrella before it started raining. As the storm came over everybody, you saw short delta work and you saw short vega work. Basically, markets moved down and vol collapsed at the same time. Everyone's going, the VIX is broken. Everyone's scratching their head. They're going, this doesn't make sense. Now you get to a point where I don't know if we're there yet, but I think what you're saying is we're going to see a point where you're basically going to get vol that's doing the exact opposite. It's super, super cheap. You're going to get to a place where people become a bit complacent. And that's effectively where your sort of second move thesis comes into play. Is that right?
That's absolutely right. So now it doesn't happen quickly. It usually takes longer than you expect. There's a history of it. I don't know that I want to go through the whole history, but I can real quick say August 15 was a massive vol event. Blew out all the shorts involved. That was the yuan devaluation, which led to Feb 16, right? A bigger decline that ultimately vol got absolutely decimated. And after that, everybody's like, why would I ever own puts again? It didn't even work in the biggest decline we've had since 2009, right? And they started selling vol, and that led to successive vol selling reflexive. That was pinning vol throughout 16, 17. 17 was the lowest realized vol in 150 years of history by 30% because of the amount of vol selling and the Tina effect and the chase for yield, which eventually led to too much selling, which led to the vol apocalypse. Everybody said, oh man, that was crazy. I'm never selling vol again. Those people are idiots. And what happened, right? When nobody wants to sell vol, what happens? All the way through 18, vol's soft. The decline, October, November, December 2018, when when Powell tried to raise rates, right? That was an incredibly vol decimation, similar to what we're seeing now, and it didn't work. And it was a 19% decline, the biggest decline since 2009 again. And vol didn't work because people were long vol and hedged again. So people threw in the towel, said, "I'm never buying puts again. They're worthless. They don't even work when the market goes down." And then what happened? Right, 2019, vol got murdered. Everybody's selling vol. People got ahead of themselves, and then Feb 2020. Boom, or the bomb goes off again. And so where are we? That was the 28% decline, the 29% decline, the biggest decline we've seen since 2009. Everybody's like, man, I'm never selling puts again. All right, so here we are. And for 2 years, skew was higher. Everybody was buying puts because this is going to save me again, just like it did in March 2020. I'm going to make a ton of money. This is easy. Look how low this vol is, suckers, and vol decimation. And so here we are. The sine curve is coming back. It's a matter of time. It's people have to abandon hedges. Now, more people like me sitting out here talking about it, right? The longer that probably takes. But the reality is, it's a function of time. People have to abandon puts. That's why we measure dealer flow and dealer positioning in real time, because you can project these things based on technicals and timelines, and that's not going to work nearly as well as if you go to the source and look at how the positioning is. And the more positioning, gets in line with people being underhedged, right? It's all a function of relative to the macro risk. I want to be clear. It's not just an absolute term thing. The more risk there is for a tail event.
How do you, because there's kind of two opposing thoughts here. Like there's the one thought, it's not opposing, but just help me understand this. There's a thought that like VIX tends to autocorrelate, and as we get down to lower levels, you see higher percentages of autocorrelation in the VIX, with the opposite thought, which is when we start to see lower levels of volatility or people abandoning hedges, that there's actually much more tail risk. How do you help me understand how I hold those two thoughts at the same time?
Yeah. So to be clear, positioning on its own matters more than the level. Okay. But that having been said, if we're going to step out from 30,000 feet and look down at history and how this correlates to VIX level, right? It's the best performance for long vol, ironically, is not when it's cheap, right? Everybody thinks, when VIX is mean reverting, you got to buy it when it's low and sell it when it's high. Quite the contrary. For the majority of the data, right, which is call it a 9 VIX, all the way up to a 22 VIX, right, which is the majority of the data. We're in the high end right now or above, right, which is not the majority of the data. It's actually the other way. When it's low on a risk-adjusted basis, even not just absolute, on a risk-adjusted basis, you're much better off selling vol when it's low and buying it when it's high. In that data set. Now, eventually, it's more like a U when you look at the whole data set, because when it gets into the 35, 40 area, it is a sale, right? On a risk-adjusted basis, you do better in that area. But there's this area, 17.5 to call it 27 or so, when long vol actually performs way better historically on a risk-adjusted basis, and selling vol is incredibly dangerous. Why is that? Again, goes back to positioning. When vol is that low, generally is very well supplied, right? And very compressed. And generally there's also, it's a placid time. There doesn't tend to be a lot of risk in the market otherwise, right? Whereas when you're at 20 or so, right? There's a reason you're at 20. There's a lot more macro risks out there. And generally vol is not as well supplied. And there's a much bigger tail when vol is not as well supplied. Now, during this period, it's been a little bit different because of the size of the decline and how we've slid down the curve and the macro risk at the same time, while vol is relatively supplied. But historically, that's kind of a way to think about it. It's not as easy as, hey, vol's cheap, buy it. You would have gotten crushed in 2017 and 2016 and a lot of other periods when vol was, even on a risk-adjusted basis, if you tried to buy vol at those lows. And similarly, if you're in that mid-20s, a lot of times in history, 2007 would be a good one. 2000 would be another good example, right? Where we're in that mid-20s for quite some time, you would have absolutely gotten killed if you tried to sell it in that window.
Gem dropping gems on me. Let me ask you, you've had this 3 to 9 month window, I think. I think we're getting into a period where you've basically said you could potentially, you could see that second move that you've been talking about. I'm curious, what is it about this window of time where you feel like the market could potentially be more susceptible? How does one come to that conclusion, if you don't mind me asking?
Yeah, so
I was
people
just
ask,
about to ask this because when you came on last time, you told us how we could see a rally into the summer and then bounce down into the fall. And here we are, first day of fall, and we've been falling for the past month. So look into your crystal ball once more.
yeah, absolutely. Look, people have yet to abandon all their hedges. People are very bearish, not just short interest broadly, but and they're hedging less, but they're still very underweight. And they're not selling vol as much as you would think yet, given the success of doing so. We're getting there. But this was, again, this is a feel thing. Predicting where that's going to be versus where it is now is not a science. But people ask me a lot in the summer, how far are we? Are we there yet? Should I be buying these puts? They're getting this all the time, right? And I
bet that's like 8 out of 10 of your DMs. Right? Should I buy puts today?
How about now? But late June, I came out and I was like, look, stop asking. It's a minimum of 3 months away. And they're like, but okay, 3 months, but like, what's the window? And I'm like, okay, it's happened. We're getting there, but we're not there yet. So let's say 3 to 9 months. Okay. So this is not scientific. I don't want to say like 3 to 9 months is exact, but that would make sense as a window. And here we are almost to the end of September and vol still hasn't worked, right? That doesn't, to be clear, when I said vol not working, that does not a matter of the decline not happening. I've been very clear that we're going to continue to kind of work our way lower and have counter trend rallies. But we're not there yet. And my guess is, and part of why I said 3 to 9 months too, is nothing is more disappointing for put buyers this year than for it not to work in the fall, right? Everybody's been waiting for September, Baba Yaga here, my stuff's got to work here. When it doesn't work and you get to the end of the year and people are looking at those long vol funds and their puts and they're looking at their statements like, oh man, I'm not buying puts anymore. I'm redeeming for that long vol fund, especially if you're down and the market's down at 37.75 here and down, 20% right? And your puts didn't work, man, that's disappointing, And it's not the long vol. Again, we've done well in our long vol fund, but I can speak for a lot of other long vol managers who have just gotten absolutely murdered, and it's not their fault. They have a mandate, and it's not working. But it's enough where people needed or wanted that versus all this other stuff that they're long and it didn't work, and people are it's human nature. People are going to give up. And so people are in the process of giving up. They've been holding out hope for the end of this year, for this fall, to get that move. You get December and redemptions and new managers with new, all those short ball strategies are going to go out and we're up 25% for the year. Like short vol is the hedge you need to the downside, right? But be careful chasing returns. Because there's a tail on those strategies. And I wouldn't be surprised if Q1 is when we start to see something. Maybe it takes a little bit longer, but the macro is culminating, right? It's getting worse. The tail is getting bigger from that in that respect. You start to see a 30% plus down market, right? The tail just naturally grows for other reasons. There's a lot of other things that can go bump in the night where liquidity can break. And again, it's a function of those things in the context of positioning. And so I could see some type of counter trend end of year move, right? People get all, excited. The vol decimation that we see is even worse. And
Jerome Powell's a hero. He was right. You guys were all
going to get
wrong.
another yields, first run to 4 here, and then they back off to 3, and people like success again, the whole story. So that's what I think, but it almost always takes longer than I think.
Jim, you just brought up yields. Tell us about where you think yields are going the rest of this year, because I know the 60-40 portfolio has been getting absolutely decimated. But with yields looking so tasty, dare I say, up at 4%, I was looking at a bank rate yesterday, 3% on a 1-year CD.
Yeah.
I heard what you. I heard what Jim. I heard what you said about interest rates, and once I heard where you thought interest rates could go, I had to go put on an adult diaper. I had to go put on a Depends because I was like, "Oh my god!"
Yeah, I want to be clear. Since 2020, I've been calling for 5% plus yields, and everybody pretty much laughed me out of the room every time. And this has happened again and again. I got laughed out of the room when I was calling for 6%, right? In just a couple months ago, right? When the 10-year moved from 3.5 down to 2.5, right? Everybody's like, here comes the recession, and 10 years going back to 1.5%, blah blah blah, right? And it didn't take long for it to get right back to new highs. This is a process. It doesn't happen in a straight line. But the important takeaway is structural core inflation is just, it's just getting started, right? And you have to look at the dynamics, and you got to look at the numbers and see what's actually happening underneath the surface. Commodities are the only reason inflation has not been worse. And people aren't talking about this enough, but that is so driven by the SPR and the release of 2/3 of the SPR in the last 6-7 months. The supply side on commodities is so tight. If you look at backwardation and the shape of the curve and what's happening, that market, the supply and the commodity side of things is, catastrophically dangerous. We created the SPR in the 1970s, not a coincidence, to protect against the last time we were in a precarious situation in a competition game where other countries could hold it as a lever against us. And so we created the Strategic Petroleum Reserve to protect, to not allow other countries to hold that commodity, sword over our head. Well, guess what? Here we go again. And this is a politically driven release, right? People, we need to help people, the populace, politically. We need to deal with inflation in the short term. So we're doing a short-term thing, which puts commodity, and that we pay for short-term decisions like that. At some point, that supply that's been released will not be there, and nobody is in a position to release and meet the supply demands. Even if we get a cyclical downturn, these structural inflationary effects there, which have been positive, good for inflation, are actually going to turn the other way as well. So there's a lot of things here that tell us the odds and the probabilities are very high for continued secular inflation actually getting worse than it is now. We've called for this for some time. We continue to see it. The data's there. Just take a look, right? Everybody is, thinking cyclical and not thinking structural. Cyclical is all that's mattered in a supply side economic world where it's always the same reaction function. That's not the world we're in now. You have to think about the two being disconnected in a lot of ways. And again, I haven't even talked about this. We can go back to the macro stuff, but I actually think what the Fed's doing is actually going to exacerbate structural inflation, not just not make it better, right? It's actually going to make it worse. And I can get into why that is, but there's, this economy does not work the way it used to. The Phillips curve does not work. This trickle down economics where, hey, if we take money away from Planet Palo Alto, if we take money away from these corporations, they'll have to fire people and that'll work through to labor. We've had globalization for 40 years. The people working for these corporations, for the most part, are not here domestically. That's one. Two, we kept interest rates at zero for all this time. The other pathway that we've been able to affect demand is through real estate. Most people who own homes, right, have locked in longer term interest rates and are not getting hurt by this rise. Now, people who can't afford homes, different story, right? And we will address that. Quote my word, quote me on this. We're going to have first-time home buyer tax credits in the next 4 years for sure. You're going to address those directly via more fiscal, but we're likely to not only not improve things because of how the market works now, how the economy works, but importantly, when we get a crisis, we're likely to get even more fiscal. It took COVID to get $10 trillion of fiscal policy. if you cause another crisis, you're going to get more fiscal policy. So ironically, you're likely to kick off more demand side economics by causing a crisis. And importantly, I've talked about this on Twitter, but the other effect is you're taking money away from Planet Palo Alto, which is supply. So you're also not going to have the globalization push, the technology push. You're not giving money to supply anymore. A lot of these goods that have been delivered for cheap are going to get more expensive. And we're seeing that, corporations are having to now make money. Your Uber doesn't cost quite as little as it did, several years ago, because we're demanding, profits from these corporations at this point because the cost of money is going up. So ironically, I think the Fed is not only, not going to win this war, they're going to make it worse through their actions. And all of this in my book means secular inflation. Even if they're going to cyclically slow down demand by slowing the economy, they're going to exacerbate the structural effects and make it worse.
Yeah, Ken, one of my favorite tweets that floats around every few months is like, if you've used Uber or Sleep on a Casper or a number of any of those other startup companies that gained popularity in the 2010s, something like venture capitalists have subsidized your consumption to the tune of $16 billion. And in a zero interest rate world, that's potentially feasible. You can take that kind of risk. But as the cost of funding goes up, those VCs are just not going to sit back and hand you cheap prices. So, one thing I frequently hear from people in New York is, wow, the cost of my Uber from the airport was $150. I'm going to go back to using the fixed price yellow cab at $50 to go back to Manhattan now.
It's very real. People are always scratching their head about how does this transmission mechanism work when the Fed, lowers rates. I don't think that really affects demand for, deflation. How does that work? That's exactly how it works, right? Venture capital, private equity can borrow money. Corporations can borrow money. They can do loss leaders, right? They can do things along this line that are deflationary. They can fund, faster, cheaper goods, right? And more efficient things. Again, just look at Amazon, right? What a deflationary force that has been. And again, they were able to do that by 30 years, of no profits, right? And that's free money from the Federal Reserve directly causing that deflation. And guess what? Now they have to make money, and all your goods on Amazon are more expensive. Now that there's no competition, right? Now that the big box stores are dead. And guess what? There's less people working. There's just less people working because technology means less labor, and it means more efficiency. So we're in the process of I use this analogy, it's kind of hokey, but I think, if you look at the Mesozoic era, right, there was just a lot of oxygen in the air. And what happened? Dinosaurs got really big. They got really big. And the more competition there was and oxygen levels depleted, you had mass extinction, you had mass competition, and a lot of different species died out and eventually, transition. There are other issues at hand there, but the point there is you give free money away. It's just oxygen. It's steroids for the system, and corporations, technologies, all kinds of things strive, and all of a sudden you take that money away, and everybody's fighting a little bit more, right? And not just internally, not externally as well. And that's what this cooperation game versus competition game I talk about is all about.
Jim, let me ask you. Go ahead.
Go ahead. It's your show. Go ahead.
Well, if I could ask you more like, I don't know, maybe it's like a philosophical question. It seems like going into this period, there was sort of almost a failure of imagination. Really, it's recency bias, right? You've been in this environment for 40 years where you've had the same mechanism that sort of underpins your dollar cost averaging strategy. I've called dollar cost averaging basically risk management for lazy people. And so you've sort of been in this environment where that works, and a failure of imagination to think about a cycle outside of what we've seen over 40 or 50 years probably caught a lot of people off guard. So it's a two-part question. One is more direct, which is, what do you think the fate is of passive investing through this potential, decade that looks very different than the last 40 to 50 years? And the second part of that question is just, what do you have a part of your process that helps you to mitigate against recency bias and sort of a failure of imagination that some investors might find themselves in?
Yeah. So, first question, it's not just a failure of imagination, it's incentives, just like anything else, right? Passive investment, everybody thinks it's like a new technology. It's a new thing, passive investing. Check it out. The reality is passive investing didn't work until 1980, right? It didn't exist because it sucked. It didn't work. Why? 68 to 82, markets went nowhere in nominal terms for 14 years. In real terms, lost 67% of their value. What wealth advisor was, suggesting people go into the, spiders and just buy and hold, right? It didn't work. Now, the Fed started stimulating and bonds were coming down off of, record yields, right? And pushing market out the risk, money down the risk curve, and stocks and bonds, shockingly 60-40, right? This whole idea of bonds, hedge stocks, it's a free lunch, right? The Fed was pushing everybody into the market. That's what they did. And trillions of dollars new industries were brought up overnight. Vanguard, was created, it's really, really easy. Who needs to, I have a PhD nuclear physicist on staff. I have like all these guys that cost a lot of money. It's hard to figure this stuff out. If I could just make my expense ratio 0.1 and have everybody buy and scale to $1 billion, right? Like that's a lot easier. Right. And it works. Why would you generate alpha? Why would you even care about edge and alpha on a risk adjusted term if the Fed's just going to stimulate? You're going to make 15% a year, which is what people have made with zero inflation, and reduce your volatility by buying bonds too. It's been easy, and everybody. It's also, in the 1970s, people didn't understand how the market worked and people didn't try it. Professional investors were where people went. Nowadays, everybody's a trader. Why? Because it's been so easy. Everybody can manage their own money, right? They just need a dollar cost average, to your point. And now recently people are having rude awakenings, like you said, because a lot of moms and pops have just assumed that would, you just keep buying the dip and eventually it works out. They have been incentivized, and more importantly, the wealth advisors who tell them have been incentivized to keep up this process because that's what works. And most of them aren't well educated, don't know any better because that's all they've done for 40 years and it's worked. And so that's what they tell people to do. So it is a bit of a failure of imagination in the sense that these wealth advisors and people who control money have not had to think about it, but more importantly, they've been incentivized to not have to worry about it, and they can easily accomplish scale and get and gather assets by doing a very simple thing, which is dollar cost averaging 60-40. So that has hollowed out the active management world. Again, incentives. Who is going to go do active management except this guy?
Just you and Kathy Woods.
Oh God, dream team. No, we're just going to barbell it. Yeah, just us and Kathy Wood. But it's the reality is that active management has gone the way of the dodo. Too expensive, everybody said, right? It's too expensive. Why would you pay those fees? Have you seen the last 20 years of relative performance? It's a function of all those fees, right? That's the reason you've underperformed. No, it's a function of money. Markets just go up.
Yeah,
right. It's just a function of beta. And so people are going to wake up to that again. If we go through a period here, it's going to be a great time for active management, and people are going to go from one side of the boat to the other, probably way too late again. And we'll get to a period of passive redemptions and everybody saying passive is stupid. It doesn't work. And that'll be the time to just buy and hold again.
That's how it works.
Yep.
Jem, it's always a fascinating discussion. You're always generous with your time. We want to thank you so much, as always. If people want more from you, they want to find out. If they're not following you on Twitter, I don't know what to tell you, people. You got to follow Jem. Maybe you can tell them where you are on Twitter if they want to find out more about what you do, where they can go as well.
Absolutely. So at jam_croissant. It's a play on my name, Jem Carson. That's my handle on Twitter. Kai Volatility is the name of the firm. We have 3 hedge funds. One's long vol. 2 are non-correlated absolute return funds. Come check us out, kaivolatility.com. We put out a quarterly newsletter. The next one is going to be about volatility and inflation and the connection between the two. So that should be pretty interesting. We've never seen in a period of inflation while options have been actively traded. So we don't really have data. We have some interesting thoughts there. You can subscribe to the newsletter and get weekly kind of video feeds. kaivolatility.com/news to sign up for that. And you can also go to my Twitter handle and it's pinned there at the top. So come check us out.
I went to the grocery store to grab some milk today. You're never going to believe this. And I'm not just saying this. I went to the grocery store. I had to grab some milk today, Jem. And I'm in the milk aisle and I'm thinking like, when was the VIX created? Like, when did we get skew? And then I'm starting to think like, wait a minute. These things weren't necessarily around. If you actually wanted to do some sort of comparison, how well did vol? Yeah, exactly. How well did vol perform during these periods? I'm like, you actually probably can't do that. So the fact that you've got something coming.
There's no good data before 1990. And even that is like really bad. They only in 1972, they launched options, but there was not only no skew until 1987 in the crash, but they only traded calls. Puts were like the people had to structure puts by doing calls and the underlying together. So, very nascent market until really the mid 80s. So yeah, there's never been really a time of inflation and, volatility products at the same time. So we're at a very unique time in history and we'll be talking more about that.
I'm looking forward to reading it because I'm pretty sure my very elementary Excel skills would not allow me to put the data together to come up with any usable insights. Jem, we did this last time. If you don't mind, I'm going to do it again. Let's put you on the hot seat. We'll go through just a couple asset classes. You just tell us lean long, where they're today, right now, you lean long or lean short delta. This is not meant to be any investment advice, anything of that nature. And we all know your longer term views, if we just discussed where you think yields are going, the potential for asset market volatility, but that we're just going to have some fun. You cool with that?
Yeah, absolutely. Let's do it.
Long delta, short delta. We'll start with E-mini S&P 500.
Start dollar cost averaging long.
Nicely done.
Yeah.
The yield curve, and I'm saying that on purpose because you can go one of two ways. You can tell us how you feel about the 2-year, the short end, tell us how you feel about the 10 or 30-year, the long end, or tell us how you feel about the 210 inversion at whatever, 50, 51 basis points, whatever. Or you can do all three if you want.
Yeah. So in the very short term, I think the 10-year will run to 3.85, 3.9. And then I think it'll back off into the end of the year. Like I said, maybe even get down to 3, sub 3. We'll see. People will celebrate, and then we'll be running again to 4.5. This is start to expect this up and down, and then 210. It's going to remain inverted, but more importantly is the duration. So you want to be long that or short the 10-year and long the 2-year because of just the duration and the continued expansion there.
I don't know how to ask this. I said just vol last time, and you gave a really very nuanced answer. So I kind of want to keep it open-ended the same way. Okay. Volatility or vol.
Yeah. So as we kind of touched on before, we're not there yet. So vol, I think, continues to underperform into the end of the year. Important at this very moment. You got that JP Morgan trade coming in at the end of next Friday. People are front running it. You saw a absolute murdering of vol today. I would expect more of the same by mid to late next week. They'll probably bottom it, and then the market will go higher. You'll see a lower VIX, but fixed strike vol will actually probably bottom and actually do quite well into a rally probably.
And the U.S. dollar
goes higher.
A wrecking ball.
It keeps wrecking.
Still a wrecking
it's
ball?
Not wrecking stuff. Yeah, it's going to go to 140 at some point here, and it's going to get ugly. But not yet. Not yet. I think, again, we're going to go a little, all these things, we're going to get a little more pressure in everything, 10-year, the dollar, everything for a little bit here. But then I think we'll back off into the end of the year, relief rally, end of year chase, and then see something early next quarter.
So I'm guessing I'm gonna throw in a fifth that we didn't talk about last time. I'm guessing emerging markets are a no-go for you.
Depends that one. It depends on the emerging market, right?
All right.
So somewhere like Mexico looks pretty dang good right now, but I'd stay away from China. Yeah.
Brazil, India.
I think India does quite well. I think secularly, India is in a really great place to play both sides and to benefit from everything that's going wrong with the bifurcation. Brazil, political disaster. Stay away.
And then last time we said energy. I kept it open-ended. Didn't say oil. Said energy. I think you gave us your thoughts on crude oil. I don't know if you spoke on natural gas, but you definitely said find a way to get long nuclear. I think at that time, CCJ was trading like in the 15s or something. It spiked to 30. Japan. Lots of people are coming around to the idea of nuclear. So same open-ended question. Energy.
Buy it. Commodities.
It just doesn't matter.
This is. I think this is a gift. I think this pullback is a gift. Everybody is worried about cyclical. Again, this ties in that cyclical structural issue. Everybody's worried about cyclical deflation. The structural issues are big, and the only reason that this oil is where it is now is because of the SPR. I want to be very clear: the supply dynamics are ugly, and not just for oil, all commodities. Copper, same thing. U.S. gas is going to catch up. You're gonna see a kind of a merging of maybe energy gas and Europe comes down a little bit, but more importantly, U.S. gas is too cheap. I know there's structural reasons why that is. I think that we'll continue to see onshoring here in the U.S., which is going to push demand of local gas in the next year.
We've got absolute savages who are willing to speculate in this chat. Whatever alpha you had in your ideas, they are going to eat it up. You just gave it away.
What you don't realize is I'm watching all their flow too. So.
Oh, touche, my friend. Jem, as we said last time, I said before, it's always a pleasure, and we hope to get you on again in the future, man. Best of luck to you, and thanks again for all the time and the knowledge that you dropped on us today.
Always enjoy it, guys. Have me back anytime. I'll be happy to come.
All right. Take care.
Thanks,
Take care, guys. Bye now.
Jem Carson, everybody. Jem Carson, thank you very much, sir. We will talk to him again in the future. The guests we've had this week, Chris, they're the type of guests that I don't really like watching myself, but the type of guests we've had on, I go back and I watch these 3 or 4 times just to try to pick up everything that they're saying.
I'm with you. I mean, I watched the Michael Cowell interview already this week. I got some weekend watching to do now for this Jem Carson interview. But it's great when we have guests on that can make us smarter, right? Because they bring up a lot of great points. I think when you look at the world the way they do, they're not thinking about their next trade tomorrow. They're thinking about how the next year, 2 or 3 may play out, and they work top down. And then they arrive at how they're actually going to operate in the market over the next few days, right? Because if it's a counter trend move that fits against their broader perspective, then they know that they need to tailor risk or put on hedges. And then once the tides turn in the direction that they feel like ultimately things will end up, the destination, if you will, then they really start to pile on and push their edge, push their luck. And that's when they start to pile into trade. So always informative when we get some of these macro minds on the show.
Oh, and Jem's kind of like the perfect combination for me because there's 2 types of sort of traders that I really like to listen to, and it's a vol trader, and it's because of their knowledge of fear and the reality that life isn't a bunch of binary outcomes. It's a range of potentials that you have to discount, and then it's the macro. So you combine those together, and it's it's the perfect combination for me. Let me say this to everybody watching the chat. I think one of the reasons we were able to get Jem back on is because the first episode we did with him was so well received. So if I could ask, we tweeted, I think both Chris and myself tweeted out a link to this episode. If you enjoyed what you heard here and you'd like to hear more from guests like Jem, do us a favor and retweet, share the post, share this link. And if you liked what you heard, comment, make some noise, let Jem know that you appreciate it and that you saw him on Tasty Trade. So make sure you mention Tasty Trade while you do it. And then, the easy way to help is just hit that like button while you're watching, eating Doritos or sour cream and onion chips, whatever it is. Shout out to you sour cream and onion fans. As we always do towards the end of the show, let's switch seats. It's not a Thursday show without charts, so let's do what we do. Over to you, man.
Sure thing. It is 5:48 Eastern, 4:48 Central Time, which means it's 2:48, excuse me. What's that math? Over on the Pacific Coast, where our friend Daniel Troutz Dabrowski resides. If we could bring him into the session here now, we got some great charts to share with everyone. Before he joins, of course, want to remind you, as just as Vic did, if you're watching on the Tastyworks desktop app, tastytrade.com, come join us on YouTube Live. Tell us what you're trading, where you're from, what you thought of the last segment. More importantly, like and retweet what Vic and I were putting on Twitter earlier today. But with no further ado, Daniel, where are you in California right now?
Hi, Chris. Hey, Vic. I am still in San Francisco. Behind me is Ocean Beach, specifically taken from this park we have called Sutro Park, which is actually right next to the background I showed you guys last week. Now, it's a pretty cool place to get some views of the ocean, and on the West Coast, we're here.
Beautiful.
West Coast is the best coast, as they say. I don't agree with that sentiment, but that's what they tell me. Daniel, we only have limited time with you.
Bro, you're like, a third of our audience, likely, you just insulted. Just slayed them down,
Only a third?
by the way. I mean, I'm guessing. We're probably popular in New York. I'm guessing like Illinois, Texas, we probably do well. And then California. And those are the states where you have like the highest nominal numbers of retail traders, but also like percentage. So I don't know. If anyone's trying to start a brokerage,
the best coast. I just happen to disagree.
I was in LA. I was in LA like not this weekend. No, last weekend I was in LA. I know it's not San Francisco, but I was in LA.
Well, maybe, Chris, you should represent the third of people that I'm probably pissing off right now. So
And that's fine. And that's what we're here for. We got the whole continental United States represented.
Yeah, we do actually. We got the Midwest, East Coast, and West Coast all represented on Thursdays. I didn't recognize that.
Well, Daniel, before we flip to your charts, I feel like this hasn't gotten a lot of coverage. And I was reading through the chat earlier that some people said they hadn't even heard it discussed on Tasty Trade. But what happened with the Japanese yen last night?
Oh, good.
It was a very, very magical thing. Unfortunately, during all this action, I was actually in class learning about Sharpe ratios. But I'm more than happy to talk about what happened overnight here with the Japanese yen. But after what seemingly months of teasing, it seems that officials have finally stepped in to intervene and prop up the currency. And naturally, of course, if you look at an intraday chart of dollar yen, it looks pretty wild. We haven't seen this kind of action in 23 to 24 years. And what's different this time around is that in the past, it was the opposite scenario. This time around, they're concerned about a weak yen. 23 to 24 years ago, it was the opposite. It was a story about a yen that was too strong. Right? Why has the yen been weakening so much? Because it's still the only major developed central bank that continues to ease policy. Interest rates are negative. They have yield curve control. And Japan also imports a lot of energy, right? So you get a widening energy deficit. And so, the government is basically flooding the global market with yen to buy up a lot of this energy stuff. That's another thing. And so on and so forth. And now it seems that they're finally stepping in here to help alleviate some of this weakness.
And when you say they're stepping in, just anybody who wasn't following, what exactly did they do?
Well, I'm not exactly sure specifically what it was, but one of the ways you could go about into intervening is, most countries have a buildup of what's called foreign exchange reserves. And you could, for example, sell those to, for example, buy up your own currency. In this case, it would be the yen. I know Japan has a very vast amount of foreign exchange reserves. And I think I read somewhere where it's like they have enough to basically sell a bunch of those into the end of next year if they need to, which theoretically could be long enough to ride out this tightening cycle, assuming, of course, the Bank of Japan still continues to maintain policy very loosely.
They have about $1.3 trillion worth of foreign currency reserves, obviously measured in US dollars there. But I would say, I think part of the reason why the market unwound its reaction today, I think dollar yen rates were down about 2.4% at their peak. They closed the session closer to 1.4% lower. Japan can't have unlimited amounts of foreign currency to sell. There is a point in time in which they run out. And that's what happened to the Bank of England in 1992. It's what happened with the Central Bank of the Republic of Turkey, CBRT, over the past few months, where in trying to prop up their currency, they ultimately ran out of ammunition. And so we're not close there in Japan, right? The Japanese Ministry of Finance has a lot on its balance sheet still that it can unload. But this is not a policy that can continue in perpetuity. So, Daniel, are you with me in thinking that unless the BOJ changes tack, this is basically hopeless, fruitless?
It's almost the opposite of the SPR release, basically, from Jem's point of view, that you're selling, but eventually, once you're done selling, market's going to lift them again. That's the same idea.
Here's my 2 cents on this, and I think I said this before, but Japan's intervention here, I think, is just another sign that the Bank of Japan isn't really going to be changing policy here anytime soon. Even though last week, I believe, we had a pretty interesting upward beat in inflation. I believe headline inflation in Japan was something like 3% year over year in the most recent reading, which is above the central bank's target. And so I think they're brushing aside this recent upward push in prices, perhaps, temporary, perhaps, which is, kind of a funny story, because if you look into the details of yesterday's policy announcement from the Bank of Japan, there wasn't really any sign of anything that they're going to change policy. In fact, it was more of the opposite. They're going to continue doing this and whatnot. In terms of whether or not this is fruitful, well, again, you have to consider the scenario here. In this case, a central bank is trying to prop up its currency. So theoretically, right, it has a finite amount of reserves to deal with this situation. But as we talked about, at least for the next year, it should have potentially enough here. But again, the main problem here is the continuing divergence and widening gap between what the Bank of Japan is doing and what the Fed is doing, what other central banks are doing. Literally every major developed central bank right now is hiking rates, outside of China. China's actually easing. And the Bank of Japan is still very loose. So at the end of the day, you have natural underlying forces. And so the Bank of Japan is trying to go against these forces, the not, I would say, quote, natural way here. So I think this in some ways could be a little bit fruitful or fruitless rather. And rather than, just helping to reverse the yen here, it's perhaps maybe it might slow the rate of depreciation is sort of what I'm seeing here.
Gotcha. Well, Daniel, with no further ado, let's switch to your charts here for the rest of the session. We only got a few minutes left, and obviously that's why people don't even come to watch Vic and I on Thursdays, right? They deal with us for like, an hour plus, and then there's where's Daniel? So let's get to Daniel here.
Yeah, we're like a necessary evil, basically. You know
we're
what
like
I mean?
The ad at the beginning of like that Hulu video you're going to watch
that you can't skip.
Yeah.
So we're a bit short on time here. So I'm only going to go over the new things here. I have 4 slides, so I'm only going to go through 2 of these. This
Take
first
your
one
time.
is
Take your time.
All right.
I'll stay here all day if I have to, Daniel.
Oh, that'd be fair.
Chris is like, what?
Excuse me?
It's like, I want to go.
What?
Nick, it's almost Miller time. Don't do that to me.
Anyway, so I created this very beautifully created sort of synopsis of the key sort of takeaway from yesterday's Federal Reserve rate decision. We can basically compare here. The blue line is the dot plot median projection for interest rates for the Fed 2022, 2023, and all the way out to the long term. And we can compare that to this light blue line, which is the OIS, or the overnight index swap. So basically the market pricing of the same sort of situation. Where's the Fed going to be? And the key sort of takeaway here, and what has persistently been the case this year, right, is that the market continues to not be as hawkish or price as a hawkish Fed as perhaps what the central bank is seeing here, because you could just take the difference between each year, so 4.38 minus 4.28, 4.63 minus 4.06, and you get these bars here. And that's basically just, the difference, or in other words, how much of a gap there is between market expectations and the Fed. And because these are all positive, this means that the markets are currently underpricing what the Fed is signaling. And we all know what that means. It means if the Fed does what it intends to do, there's room here for markets to catch up. Now, what does this catch up mean? Well, again, higher rising bond yields, rising treasury yields. Is it more risk aversion? Is the dollar going to continue strengthen? Perhaps a combination of those scenarios here. And I've also overlaid that with economist CPI projections. Now, they're not in the same scale, because if I put both of these in the same scale, this would be sitting like way up here, and this you wouldn't really be able to see this very well. So this is tied to the right axis here, but you can see the CPI is supposed to basically less than halve for next year, from 8% to 3.7%, and then to 2.4%. I couldn't find figures for 2025, so that's what we have here. But what's interesting, and we can see here that rates are projected to be above inflation as the Fed gets its job done. And rates being above inflation is what I've been talking about here through, you've seen these before, I've thrown these back before. This is 1 year break-even rates versus, market implied rate for 1 year. And as long as, the market implied rate is above break-even rates, that's, what this is sort of shaping up to be.
Daniel, go back to that last chart though, with the green bars on the bottom.
Yes.
Vic, this is what I think was the big takeaway yesterday, was when you take a look at where the market was pricing in the Fed to be at the end of 2023 and where the Fed told us they're actually ending up, the Fed was more, significantly more hawkish than what the market was pricing. And so you have that readjustment yesterday, that mechanical readjustment where, okay, interest rate expectations up, let's discount the value of future cash flows, let's reduce our earnings estimates, equity markets fall thereafter. The market today, when you take a look at the Fed funds curve, it's adjusted up to where the Fed thinks things are going to be. So the Fed now needs to ratchet things up, in my opinion, another degree. They need to pour on a little bit more hawkish heat, if you will, if you're going to see another type of step down adjustment to equity prices and valuations moving forward. So as Jem said, it's now the time to start dollar cost averaging. Look, we could fall further from here, but I do think we're going to be in a grindhouse for the next few months where we battle weaker inflation data, hot labor market data, and repricing of Fed funds expectations all around that, because we're going to play this roller coaster. We're going to go into the casino once more in December when the new SEP comes out.
Absolutely.
I guess the thought would be, if the economic data starts to roll and start to paint a different picture, does the Fed need to continue to ratchet things up? You get what I'm saying? Like, how much does the Fed need to continue to ratchet up yield expectations if economic data starts to roll, and can they maybe play the background to deteriorating economic evidence that then the markets start to use and reprice earnings and consumption expectations? Because right now they seem to be holding on to hope a little bit, or they were. This caused a major repricing. But I guess the further we go out in time, the more I wonder how much they have to continue to do. Do you have thoughts on that, Chris? Do you think they have to continue to bat the market down as long as you don't see deteriorating economic evidence, obviously?
Well, I mean, the Fed effectively told us, and Daniel, maybe you heard something different, but they're effectively a single mandate central bank right now. They don't really care if the unemployment rate goes up over the next few months. They don't care if we have recession. I mean, below trend growth over the next few months. They care about one thing and one thing only, and that's re-anchoring CPI moving forward. The market pricing in lower inflation is great, but to an earlier point, Vic, you brought this up back a few days ago ahead of the Fed meeting. When have the Fed's estimates been accurate? And more importantly, when have market measures of inflation been accurate predictors of actual headline inflation? Mm-hmm. So volatility is a feature, not a bug, of this environment.
Yeah. What do you call the dot plot gap? So that gap, has it closed today? Or is this a snapshot of yesterday's gap and today the gap is closed? Or these spreads, they still exist? Is it fair to say they still exist? When did you Okay.
This is
So
pre-CPI.
basically,
This is pre-Fed pricing.
got it. So what would you call this gap, basically? Would you call this the Fed credibility gap? This represents the degree to which the market does not believe the Fed will keep rates as high as they say they will in the face of an economic slowdown. Is that what you'd that's the way I interpret it, that the market says in 2023 and 2024 you're going to ease up much more than you're saying, and so the market
That's what the
says
market
this is going to
was
get bad.
saying. That's what the market was
Got it.
saying ahead of yesterday. And so you have that expectations gap that has since closed, which is why I think you have the
Yes.
repricing in equity markets the
Got
last
it.
2 days. And that's when these green bars at the bottom are positive, that's bad for equity markets. When those are negative, that's good because it means the market was too aggressive in its pricing towards the Fed, and it needs to take a little bit more of a dovish tack, lower rates, relatively speaking, than what was expected moving forward. And that's where you would get a tick higher in equity markets. So positive green bars, bad for stocks.
See, Chris has been doing this show with me long enough. He knows how to simplify it, so it can stick in my head. Green bars, bad, Vic. Thank you very much. Go ahead, Daniel.
Yeah, no, you brought up a good point earlier, which is, the how the economy and employment is faring. And, this is really where we could leave things off with, I brought this up a couple of weeks ago, something like for every person who is unemployed, there's like 2 job openings, right? That, or something like that going on right now. And so I went out and I've actually found and calculated this data. It's actually pretty simple. All I have to do is just take the amount of JOLTS total job openings and divide that by the unemployed people currently in the market. So the people who are the total amount of people who are trying to, if you do job openings versus that, you get this ratio. And so you can see it's hovering around 2. So for every person who's unemployed, there's about 2 job openings. And, you can see sort of where the waves came and went over the cycles of recession. So in 2008, that was just under 1. And as we entered COVID, that was about 1.25. And now that's 2. So if we're saying that the normal sort of scenario before COVID, this right here, this is how things used to be before COVID, and that's where we need to get back to, well, there's how much space you have to fall, and that's 0.75 from 2. And so I think as we go forward, I think, we're going to start focusing, I think maybe we're still going to be obviously looking at inflation, but I think this is going to be very, very important to watch in the coming months, even year, because as long as the labor market remains tight, then price pressures could remain elevated. And so this clearly shows you that there is some room here. There's some slack for some absorption. And so if you look at actual unemployment, this is the last thing I'll say here. There's 3 types of unemployment. There's cyclical, which has to do with ups and downs of the market. Structural, which is a mismatch between what firms and employees can offer. When you have a change in industry, like going from manufacturing to more tech-oriented jobs. And finally, frictional. Frictional is the time in which it takes someone to transition from job to job. So I would hypothesize here that because the labor market is so tight, and as we start to see layoffs, we probably would see a lot of frictional unemployment because there's room right now to absorb this. And for now, it seems perhaps cyclical when we talk about the ups and downs of the market, that could perhaps take a second footing here. So that is something that I'll be trying to look more into in the future. What's the level of frictional unemployment now versus cyclical? Because it seems we have room for frictional versus cyclical right now. So something to think about.
The thing that I think about as well is who's losing jobs. It's right now, it's tech firms that are laying people off, kind of cool, funky startups, those types of things. The people, the most demand for jobs, though, maybe it's waitresses, people at the grocery store, barbers, that type of stuff. And so it'll be interesting to go through this period, what type of people are laid off, at what income levels are laid off has a big impact to how you should think about the impact to the economy, right? And then yeah, it just because the way I see it, the people getting laid off right now, it's not necessarily low wage workers. That's in high demand, and there's very little supply. I guess the way that I see this chart, and you tell me if I'm wrong, I have to simplify everything again. I think of it this way: there's massive demand, there's very little supply of workers. So if you think about, if you're a parent and you go, okay, what's the hot toy going into Christmas? And then say there's 2 parents that want that toy for their kid for every 1 toy that is available. What would then happen to the price of that good if you knew that if every store knew that there was 2 parents that wanted every one of these things? Well, you'd increase the price so that you could normalize and try to take advantage of that marginal buyer. So that's what, if in effect, theoretically, the Fed is afraid of, right? So if there's massive demand for workers but low supply, what happens? You get this upward pressure on wages, and that upward pressure on wages is built in. It gets built into your model, it gets built into your prices, it gets built into all of that stuff, your financing. And so in a weird way, the bankers of the world are sort of helping to alleviate that pressure by removing the need for workers at this time. So in theory, that's the idea. If it works, I think that's the question. I think Jem Croissant put some reasons to believe that it might not work as quickly or as elegantly as many are sort of giving the Fed credit for. Did you like my Christmas analogy there, Daniel?
I really like that. And
you can use that if you want to, man. Feel free.
Yeah, and so if you want to continue on sort of thinking in that way, what I'm trying to say here is that there's not enough toys right now, but as production increases, right, we're going to see more supply come into the market, and in this case, it would be firms, if they have to lay off people because the growth is slowing and whatnot, you'll see an increase in the supply of workers, but there's plenty of jobs to go around, so there's plenty of parents to pick up these new toys. And so, if they do this right, we'll end up in a scenario where there'll be plenty of toys to go around without necessarily hurting profits, kind of to play along with what you're going here.
Beautifully done. Well done. What were slides 2 and 3? Can I ask? Or are we way over time and you don't want to show them?
You guys seen these slides before. It's just 1 year Fed expectations versus inflation, and how that continues to go into deeper negative territory, which is just another way of saying of what's this, which is in a year's time, we're seeing rates above inflation, which is basically this is another way of demonstrating that really. So, and you can see the dollar continues to rally and will probably continue to rally. This continues to be the case. So,
Chris, how do the events of this week, as we're closing out the week here, how do the events of this week change the way you're thinking about risk, equity risk, dollars, yields, volatility? How do the events of this week change your thoughts, if at all?
Probably a little bit more weakness and risk. I think the dollar still has some more room to run. This repricing is coming in, and the sheen was taken off today because of what happened with the Bank of Japan. But if you take a look at the dollar index and you decompose it into the various components, euro was still weaker on the session, pound was still weaker on the session, and it doesn't need to be organic dollar strength that moves the DXY higher, right? It can be because of the problems that you have in Europe and in the UK. I mean, I think, I hate even to suggest this, but like the key differentiating factor between a weaker euro and a stronger euro over the next few months, and same thing for the British pound, may be how warm is weather going to be? Because if you have a cold winter and demand for gas goes up, it's going to drive a deeper recession in those regions, and that's going to significantly curtail the ability of the ECB or BOE to effectively snuff out inflation. They may start to begin to turn the cheek and look towards growth a little bit more. So is the best thing for the euro, for the pound, for short circuiting this dollar rally, a warm winter Europe? That's probably the case. In the near term, a little bit more weakness in stocks, probably. I do think that bond yields can climb a touch more here. We're getting into the end of the month, end of the quarter. There's going to be some rebalancing going on. And we are so down already Mutual funds see the end of their fiscal year at the end of next month. Of course, we have the end of the calendar year coming up. I do think the potential for some chase higher into the end of the year exists. Wouldn't surprise me. There's going to be a lot of tax loss harvesting going on, mind you, because who doesn't want to put those away for a rainy day, perhaps next year. But we are at a point in time, Vic, when you take a look at the rolling 52-week returns for the S&P 500, we're down about 14% over the past 52 weeks. We're in an area where, historically speaking, you don't see much more than this. That can persist for a while. I mean, you saw this in 2001, 2003. You saw this coming out of 2008, 2009. You saw this right immediately with COVID. But deeper pullbacks in this tend not to persist that long. So thinking about taking risk, thinking about rebalancing for a little bit more equity upside, but time is your friend here, right? If you're looking for the immediate trade, probably a little bit more weakness the next few weeks. If you have a longer time span, I think, if we're at peak Fed hike odds and you're a believer in the Fed, then you're probably seeing that you have more optimistic days ahead.
Me personally, I closed out a lot of the short positions I had today. And so I'm basically flat portfolio delta. I'm not necessarily going bullish, but I do think, VIX futures up at this level. They touched like 28 today. So I added a little bit to that short VIX future position. And I think, I'll keep doing that. I'll be careful, though, to be small. Again, the velocity of risk can favor the downside, especially now that we've broken this 3,800 level. But I like the risk to reward of starting to sell the 28 VIX futures kind of real small. So that's my short-term positioning into the end of the week. I think it is somewhat interesting that we've gotten through these massive events, right? The FOMC was a massive event. You got a massive repricing, and yet still we come to the end of the week and you're still trading with the 28 VIX. I think that is somewhat noteworthy for those that might have thought vol sellers would come in after this event. You don't necessarily have expiration here. You might get some of that volatility harvest happening. It just hasn't happened. It did collapse a little today, but we're still at relatively elevated levels. We went way, way long here. Daniel, I want to thank you for being patient, coming on, hitting us with the charts. If the people want more from you and they're not already following you, I've argued you're one of the dopest follows on FinTwit. I don't know if you're frozen here, so I might just be talking to a frozen picture. But if I'm not, tell the people what your Twitter is. There we go.
It's you guys saw it earlier on the chats. It's at D Dabrowski, capital F, capital X.
My man. Chris, just make you might be on mute, man. So you might want to unmute yourself here. If the people want more from you, or if we have new fans or followers of Jem Carson that are seeing this for the first time, and they want to follow you outside of this show, where can they go, man?
Well, they can always head on over to Twitter as well, at CVECUFX, CVECCHAOFX, as it said on the bottom of the screen earlier. Of course, I'm here on Jones and Friends Monday, Tuesdays, and Thursdays, 3:30 Central, 4:30 Eastern Time. That's 1:30 for those people on the West Coast. Vic, I'm excited for the market on Monday. I'm excited to see how this market trades into the end of the month, end of the quarter. Next week should be very interesting, even if there is a little bit of a Fed hangover, if you will, here tomorrow. But don't count it out. I think that markets are likely to stay volatile here the next few weeks. And typically that doesn't calm down until the middle of October based on seasonality metrics. So stay frosty.
If you want to follow me, you're more than welcome at Victor Jones. The Owen Jones is 0 because I like to be difficult. I probably come in third in terms of interesting follows on the screen. But every once in a while, when I'm eating some Chex Mix and I'm reading the back of that cereal box, I'll come up with an interesting thought. And so you don't want to miss it. Until next time, everybody, we'll be back next week, same time, same place, same great network, only on Tasty Trade. A special thanks to our special guest, Jem Carson. We'll see you next week, folks. Peace.